what a typical day looks like for a quant trader.
If you have a strategy which is no longer performing, you look at metrics like
Annanay Kapila did his undergrad and masters from University of Cambridge in mathematics, graduated in 2020, joined Flow Trader as quant trader in September 2020, worked there for 1.5 years, joined Tower, worked there for approximately 3 years, and later in April 2025, he got into YC for his startup idea, QFEX.
So what was the biggest lesson that still shapes how you think about the markets today?
you might just want to go to your favorite bank and say, hey, I'll give you $1 billion euro. Give me a price which is better than the public markets, please, and you can hedge it however you want. Basically, there's no such thing as automated market makers. The easiest trading strategy you have is like,
What made you basically leave HFT as an industrial student?
the thing that clicked for me is, we were making a lot of money around the roll, right? So the reason I decided to move is I think like most of the money made in crypto now is made by these. HFTs should not make money, right, in general, because if you want to be a successful trader, you have to invest a lot in the infrastructure of making your strategy and your decisions and your approaches very systematic. I don't want my previous employers to be angry with me. If I leak it out into the public sphere, like, they will lose value. The only way to win is to beat everyone else, and a lot of that kind of psychology goes into trading as well.
So what was the hardest lesson you learned by building your firm in last 1 year? Thank you, Anil, for joining today. I'm quite pumped up to talk about QFEX and your journey in HFT and what made you come up with the idea of getting equity perps taking the idea from crypto and bringing it to the equity market. And what are the things, like technical things in terms of market structures and infrastructure, that made you come up with the idea and work on it, and also make you leave your HFT job. That's a quite a thing to leave at this stage. So yeah. So actually, I've been following you on Twitter for a while, and like since we're connected, and I read a lot of threads and tweets, and you have been like bashing and roasting market structure on the timeline, and how old how current infrastructure has a lot of loopholes. So I want to also probably dig into your journey from flow traders to Tower Research, and also the 24 exchange, like QFX exchange, right? So just start with walk me through your journey. Like you went to Cambridge, did like mathematics. You are a mathematical major. I remember one of your LinkedIn posts you talk about you are a math nerd. So yeah, then you moved to Flow Traders, then from Tower. So what initially pulled you towards the MIT School of Thought shop like Tower, and which is basically more data-driven engineering, I guess, compared to something like Optiva or Jane Street, which is more game theory and Chicago style of trading culture.
Yeah, exactly. I mean, you summed it up pretty well. My educational background, and then I started Flow Traders. Flow Traders, I was on the crypto team there, which was doing pretty well. And basically, the market was so inefficient at the time that we didn't even know what to automate. So this MIT School of Trading only really works when markets are really very efficient, and okay, I have to automate this thing, or there's this very consistent trend that emerges, or it changes very slowly, maybe over a period of months rather than days or hours. And then you can basically run a machine learning model on it and come up with a good price prediction, and then basically start trading those markets there. And those markets tend to be very efficient because there's data. A lot of people have done the machine learning and the hard work, and then they've got the model in place. So you're basically competing as very smart people. But because these markets are very efficient, there's also a lot of volume. So although you make less edge per trade, you actually make more money. In Flow, we were trading these very nascent crypto markets. I'm talking 2020, 2021. Crypto was really inefficient. Market dynamic and structure would change every day. And while I was working there, we were making a lot of manual decisions daily that basically would make money. I remember one day when there's a coin called NU, NU. Probably no one remembers it, or if you do, like, congrats, you've been through multiple cycles, including this one, which seems to be ending today.
Yeah.
So there was this coin NU, and it was just trading like a 40% difference between Binance and Coinbase. We could just arb that, and we made like over $1 million in a day just arbing this and moving the coin to Binance and selling. The reason I decided to move is, I felt I had a lot of technical skills that weren't being used in the kind of more Chicago style school thought. It was still like a lot of manual decision making, a lot of decision fatigue. If you made a wrong decision, you could lose a lot of money, which was, mentally quite exhausting. And my hypothesis was that, crypto trading would eventually become efficient. And, the only market we've seen that's long-term remained so inefficient, even that's kind of changing more
Yeah.
and more now. But the only market we've seen that really remained very kind of long-term inefficient to be amenable to the Chicago School of Thought trading is options. And I wasn't in options at all. I think options is like a completely different mindset, different kind of trading. So I basically thought, this crypto, which I want to stay in, crypto trading, it's going to become more efficient. Exchanges will consolidate. People will start to trade on fewer venues. And eventually, you'll want to do it more from the MIT School of Thought as well. And I think like most of the money made in crypto now is made by these MIT style firms. We're talking Jump, Tower Research, Hudson River Trading, XTX Markets. Citadel Securities not really big in crypto, but if they wanted to be, they can be. And that's why I decided to make a move. So when I moved companies, I actually had offers from, let's say, some more crypto native firms as well to join them as like an earlier employee. But I chose Tower very specifically because I wanted to learn that skill set, the technical skill set of making systematic machine learning models. I was very interested in that, both from like an academic perspective, but also I thought it was like the future of trading, even in crypto world, which is where I wanted to stay. So it was a very calculated decision. And yeah, it's paid off massively because from working in such a firm, you really understand not just like market dynamics, right, which is a trading intuition. That's what you learn from the Chicago style trading, but also like technical details of how an exchange is structured. When I send my order and it leaves my system, where does it land in the exchange? Which switch does it go into? How does the exchange do the risk checks properly? How does the exchange do clearing checks properly? How does the exchange match it in the order book? Understanding the whole order life cycle, that's been really important when we making QFEX, and really important to understand how that works.
So I just want to extend on the Chicago School of Thought and MIT School of Thought. So like, see, both are from use quantitative models, right? But the thing is, I wanted to emphasize on in which part of the whole trading process the discretion comes into the picture. Because see, if I'm working JSD, I will involve surface or some model. I will come with in quantitative parameters to come with a signal generation process would be same at the both places, both the quantitative approach and signal generation. But where does the discretion come into the picture if you're like working at Jump, because it's most Chicago School of Thought, even for JSD or Optiver, or even I talk about SIG. Like SIG is like from where the JSD came out of, right? So from which part of the whole trading process the discretion come into the picture?
Yeah, that's a really, really good question. Firstly, small correction. So Jump is in Chicago, but it's definitely more MIT school.
Yeah, I know.
Very
Sorry.
automated.
Yeah.
Yeah. But the other ones you said were all correct. They're definitely Chicago style trading.
Yeah.
And the first thing I would say is any trading strategy involves an element of discretion, because ultimately it's the quant who decides where to turn it on or not, right?
Yeah.
Or it's the quant who decides to pursue a particular line of reasoning. It's the quant who decides to, so I think somebody on my Twitter said, Chicago versus MIT, you can also split it into the firms that are led by quants and the firms who are led by quant traders or traders, right? And the Chicago ones are more led by the traders, the guys who have market intuition, and the quants kind of work for them to create the models. And on the MIT style, the Hudson Rivers, the Towers, the Jumps, the Citadel Securities, parts of Citadel Securities, they're really led by the quants who make the alphas, and the traders just kind of, if some special situations, something happens, they intervene there. More on the Chicago style, which is where the alpha is really coming from the traders. Look, there are a lot of markets out there which is just very inefficient and behave in very idiosyncratic ways, which are very difficult to capture from models. Models are really good at the kinds of trading where you can formalize some pattern you see in the market into something that can entirely be driven by order book data, or even some kind of different order book data, but generally kind of this high frequency, kind of very tightly timestamped data that can be fed into a machine learning model. And, nothing crazy is going to happen. Like, I can give some examples of when human discretion is important, right? So for example, if you're trading an ETF, so I have flow traders, we trade ETFs. You can be trading the ETF, and the ETF, the whole point of the ETF is you can redeem it against a basket of underlying goods, right? Now, the reason you can redeem it for a basket of underlying goods, or you can create the ETF from a basket of underlying goods, is because there's basically someone called a manager, basically a manager of the ETF, who will allow you to do this trade.
The creation.
Now, in a lot of
freedoms.
Exactly, creation and redemptions. Now, the problem is a lot of let's say kind of frontier countries, particularly not in the US, some kind of not to single out any particular countries, but we saw this a lot happen in Southeast Asian ETFs.
Yeah.
The issuer will suddenly block redemptions of the ETF. So if you have the ETF, you can't get the underlier. While that happens, for example, it might take 5 days for redemptions to be allowed again. So if you're now long the ETF, right, you can't go to the issuer and claim back the shares you may have shorted in order to hedge yourself from the ETF. So now you're in this position where you're long the ETF, you're short a bunch of these Southeast Asian shares, which you may have very high borrow costs to be short them. And now you're losing money every day because you long the ETF, you short the shares to hedge them, and you have to pay for the short position. And you can't immediately cash out the ETF to cover the shorts because it's going to take multiple days. So when that happens, the ETF starts to trade at a discount to the value of the shares.
Yeah.
So say, the ETF, you have like 50 shares in the ETF, you know exactly what ratio the shares are in. You can compute the expected price of this ETF,
Yeah.
the price of the shares. It may trade a discount to that. That's very hard to systematically put into a model because the ETF issuer might just call you and say, hey, by the way, I blocked redemptions. How is the model going to know about that, right?
Yeah.
So when that happens in the model, you have to change. That's a manual decision. You have to think, okay, do I stop trading? Do I hedge immediately? Do I, do I just continue to quote these ETFs but at a discount? Do I buy the ETFs at a discount? Probably you would do that. Would I even sell some of the ETFs at a discount because I don't want to hold this position for multiple days? How long do I think the ETF creation and redemption is? It 1 month, 1 week, 1 year? How long do I think they're going to be blocked for? So all these decisions, they're pretty manual. They depend on the relationship between the issuer and the ETF. I would say any place where a lot of price dynamics are determined by kind of phone calls and text message chats. Still happens a lot in, let's say, European equities. About half of the flow actually comes in chat rooms because the flow is very blocky. People want to do huge amounts of volume at one time. They don't want to trade slowly over an exchange. So they'd rather do it in a chat rather than on exchange. That's when human discretion is really important because it's very hard to feed that kind of information systematically into a model. And if you look at where Chicago-style firms have historically very successful, it's typically in options because options have this very idiosyncratic moves. Volatility can move in a very dislocated way, whereas your prices tend to move pretty steadily. Kind of frontier markets, illiquid markets, inefficient markets. That's where discretion is important because the models don't know what's happening because something random could happen that's never happened before.
Yeah, actually, I've talked to a lot of vol fund managers before and in last few years, and most of them have they have a semi-systematic approach to this. They will have their models which will come with signal and all the calculation, but the manager makes the final calls on all the trades that you'll be putting in the system. So a lot so that's basically I think one of the options. That's why we have Opti or Pearly, which is a very big option shop, have this approach.
Yeah, and I think another point you mentioned though, which I'll just kind of say explicitly for the viewers is generally longer term. So hedge funds generally do longer term trading. They don't try and do very short term trading.
Yeah.
They have to have this discretionary approach because models are, a model can predict very well usually where price of something is going to go in the next 100 milliseconds, right?
Yeah.
Because on the very short time horizon, the 100 millisecond prediction is mostly driven by dynamics of the order book, and order book data can go very cleanly into a model.
Yeah.
Now, where is a stock going to be in 1 year's time? No one really knows. Even if you put all the data, it's very hard to get all the relevant data.
Yeah.
It's very hard to consume it in a model in a very systematic way. And even if you got a very good model to do this, a really good model for 1 year down the line might have an R squared of 0.1.
Yeah.
Right. And that's really, really high prediction. Whereas, if you want to predict something in 100 milliseconds, your model could have an R squared of 0.2, 0.3, 0.5, right? It can be much higher.
Much higher, yeah.
So, I think any kind of trading where it's very long term, that's going to be very discretionary. Even if you take very, very, very good shops like Citadel Commodities, for example, one of the most successful hedge fund units in the world of all time. They have a very data-driven approach, but they have almost nothing which is fully systematic. Almost all their money is made by kind of systematic machine learning, alternative data fed to a portfolio manager who then makes a decision. And a lot of this kind of market making for frontier instruments, illiquid instruments, you end up having to hold the position for a long period of time. It's not like, let's say Tesla stocks where, you buy and you can sell immediately because the market is so liquid. And that's also, one of the reasons why this stuff comes in this manual decision making basically comes into even market making is these illiquid instruments. You have to hold the position for longer. So it's not really very high frequency market making. It's kind of you end up in this position which isn't perfectly hedged and you have to make a manual call. What do I do with this position?
Got it. So basically I just want to understand what a typical day looks like for a quant trader or working at a like Tower or working at HRT. So like, what does you do at like on day-to-day basis? And thinking back, like, what was the most mind-bending edge you have worked on? Like any stories related to latency, adverse selection, like I've seen like you do like HFTs use a lot of order book mechanisms and data to predict like next few seconds or milliseconds,
Yeah.
and then they create the edge over it. So if you can just give
Yeah.
me example of that and talk about the day, like how does it look?
Yeah, sure. I'll talk about the day first. You kind of mentioned Tower HRT.
Yeah.
We have a very different, day to day something like Flow Traders, where I was working before. During the market hours, I was 100% focused on the market. So basically adjusting parameters, adjusting strategy, and then after the market closed, we got to work on some projects. So maybe 70% live trading, 30% research, systematic research, coding, data analysis, and so on. Tower is almost exactly the flip. So I would say about
Yeah.
70% research and systematic research and a lot of coding, improving the strategies. We would kind of write the C++ code ourselves for
Cool.
the strategies in that case. Not rely on making tickets for developers to do it. And about 30%, I would say, would just be usually not live decision making, but decision making around, which strategies are doing well, which ones to
Yeah.
cut, which area to inform our analysis. Some changes happen in the exchange or some new features come out, and basically tweaking the strategies so that they work in case of any special upcoming situations. So yeah, like I said, we had this system basically that would ingest market data, evaluate a signal, which was based on a model that we trained, and then do trading and order entry around that. And typically the way we would inform our analysis is we would try repeatedly to find out. We had automated scripts for this. Where were we losing money? Which opportunities were we missing? So that's step one of the process. Is like,
Yeah.
where is there money to be made? What opportunities are we missing? Are there any new opportunities? Any changes in the exchange, or any changes in code, or any new findings that we have which we can use to improve the strategies? Strategy improvements kind of went into two camps. So there's improvements on the model itself. So maybe there's like some new mathematical insight about how we can fit the model better. Some new insight into some way the market is behaving that we would like to capture in a new feature that we put into the model. And then also execution improvements. So, things like improved latency on order entry, that was the bulk of it. Some new kind of ordering behavior, things like that. That was maybe a smaller part, maybe 20% of our time. And then, once we have this idea, what we can do is we can basically come up with a null hypothesis and a new hypothesis. So null hypothesis is, existing thing works and is optimal. Not, new hypothesis is, if we make this change to the code, add a new feature, train the model in a different way, change the way we do execution, then, we should be able to make more money. And we had a pretty standard stat. We would basically make the code change. We would compile a new binary, basically, that we would use for trading. We would train a new model, maybe if it was a model change. And we would basically run this change in a simulation environment over multiple months. And then the simulation environment was very high fidelity, very accurate. It used the raw timestamp data that we've recorded from the exchange. And the way it worked is we would basically set up our trading strategy, and it would connect to basically a fake process that was feeding the data as if we were getting it from the real exchange. So it was not like a separate backtester that we built. It was the exact same trading binary to ensure exact alignment with a fake exchange that had been set up to literally replay recorded data.
Yeah.
And basically you can then get all the strategy characteristics. You can look at, how does the P&L change? How does the Sharp change? Did the number of down days go down? All that kind of stuff. So yeah, that was our process. If we saw a significant P&L change, basically we would then merge this into the main branch, and the next deployment, the strategies would have this new improvement. And that was basically how I would spend 70% of my day. And then, yeah, as I said, 30% was basically, reacting to short some stuff. Maybe there's a data release coming out. We want to probably turn the strategies off for that, occasionally size up the strategies for that. It really depends on the nature of the strategy. There's like a long holiday coming up. How do we change ordering behavior? Little tweaks here and there, basically. That was a smaller part of it. So yeah, very research driven, very systematic. At Tower, even the traders knew how to write pretty decent C++, I would say, as well as robust Python data analysis scripts. And we had a pretty good pipeline that we worked on every day. So it was mostly about working on the pipeline rather than making live trading decisions.
Also, when you talk about like there are two ways to look at the strategy. One is you look from model point of view, and one is
Mhm.
from the execution point of view. So I just want the my audience to understand in more detail. So let's say there's one strategy, something like which is not performing for like last few months or so, and you want to dissect it, why it happened. So how do you decide which approach to take first? Do you go to first look at the model, or you do look at the market microstructure, like the basically execution part of the things first? So how do you decide
Yeah.
which thing should be looked at first?
Yeah, and the great thing about like so a lot of firms actually concretely separate the alpha, the model part, and the monetization, the execution part of the role. Citadel Securities does this very well, where they have
Yeah,
monetization quants and alpha quants basically who
yeah,
work on separate parts of the pipeline. The nice thing is the modeling part is kind of independent of how much money you're making. So
yeah,
you can just tell, basically what you do is an out of sample
yeah,
test where you basically say, okay, this is my model, and this is some data that the model has never seen before. And now I want to evaluate this model on the unseen data, and I want to see how accurate the prediction was, right? So if you have a strategy which is no longer performing, you look at metrics like, when I did training, this is how accurate the model was. We use something called R squared, called the coefficient of
yeah,
determination, along with other metrics which are a little bit more proprietary. And you can see, okay, my model said it had 30% accuracy during the training set, and when I ran it live, it only had 5% accuracy. So probably the model has decayed.
yeah,
Sometimes that may just be a case of retraining the same model on new data because the market has shifted, but the model is sufficiently robust that it will just learn the new patterns in the market. Sometimes the case of something has fundamentally changed the market. You need to actually tweak the model and like how you train the model.
yeah,
And if the model hasn't really decayed, if the accuracy is still fairly consistent, then you can start to look at other kind of red herrings. So not red herrings, other smoking guns, actually, opposite of red herring. So you can look at things like, is my latency gone up? You can look at things like fill rates. So, say I have a strategy which takes liquidity. So it's an aggressive trading strategy. Now, that it could be that every time I send an order, 50% of my orders would get filled.
yeah,
And 50%, the market would move away from me before the order got filled. Now, if that decreases a lot, it decreases to 10% or 5%. That means somebody has probably come faster, but they're using the same alpha as me. So then I need to dig into the exchange microstructure. Has something changed on the exchange side? Is there a regression in our C++ code that makes the order latency a little bit slower? And those things that also, you can debug like pretty systematically. So, we had monitoring scripts in place for all this kind of stuff. We would know when decays start to happen. And you can look fairly systematically. You don't just have to look at P&L. You can basically plot P&L and see how it changes over time with all the trades you do. So, on a trading strategy, you want the long run P&L of all your trades to be, positive, not just kind of the trade at the point of execution, because otherwise you have adverse selection.
yeah.
And yeah, we basically had like pretty systematic and non-systematic ways of looking at all this.
So looking at your time at Tower, so what was the biggest lesson that still shapes how you think about the markets today? So you've talked about publicly things like B booking, incentives, last look delays, and even exchange pocketing some PNL. So what were the red flags you started noticing that made you wary of the OPEC venues? I especially remember you talking about this in one of your tweets about B booking and the exchange taking up pocketing the PNL. So yeah.
Yeah, so I mean, like the biggest lesson I learned, to be honest, is there's a lot of exchange models, and a lot of exchange models work. So it really depends on product and what the customers want. It's just like any startup, right? Like the exchange has to work in a model that the customers want, and different models work in different ways. I think one of the best thinkers on exchange microstructure in particular is Alex Gurko. He's not on Twitter anymore, unfortunately.
XTX founder. Yeah,
XTX founder, exactly. So XTX, I think, are probably per person, I think they're the biggest, most profitable trading firm.
yeah,
They have very small core team, very strong,
yeah,
making high. I don't even know. I'm gonna say billions, right? High billions. It is. I was gonna be like, is that 9 figs, 10
they're very
figs?
secretive. Like they're not as public as the
Yeah,
other firms. They're very secretive.
yeah,
Like they don't even
yeah,
have
yeah,
these
yeah.
red programs like Optiver have all these programs which happens all over the year, your flow, and every like big shop we have these programs try to attract the talent. But they don't have these I think they go more for the PhDs as compared to undergrads. In my
I know a guy who got an offer there who
yeah.
didn't have a PhD. I think it's more a case of they find you rather than you find them. So
Okay.
it's elite PhD programs. If you're kind of on the right team at a top trading firm, they may try and poach you. It's a little bit of a, it's very opposite to like a Citadel Securities, where a lot of people leave after a few years. It's a very high churn. They have very high retention, not completely independent of the fact that they have like a 5-year non-compete. I've heard like crazy number of years of non-compete for the core team, like the core team.
Yeah.
So yeah, what was the original question? I guess it was
So yeah, we were discussing about like booking incentives, last look delays, and exchange pocket PN. So you came up with you're talking about Alex in terms of market microstructures.
Yeah, he's a super smart guy. I would anything I say now, he probably will explain better. So if you want to read his stuff, but it's very technical. It's really made for like people who know a lot about markets. So I'll try and explain things simply.
Yeah.
There are lots of different market structures that particularly crypto has come up with. I think the two main systems that have come up with in traditional finance is basically this kind of ECN structure, which is basically traditional finance has two types of market structure, pretty much. Like there's lots of different tweaks to the rules in different markets, but on the one hand, you have something called the central limit order book, which is typically used in futures markets. CLOV or CLOB. That market structure is basically very transparent, very open. Everyone is on the same footing. Everyone gets the same market data. It's basically like, we're not going to give anyone any preferential treatment. Everyone trades in one place. The advantage for that is, you don't have to worry too much about, hey, am I, is there some other source of liquidity I'm not seeing? There's no liquidity fragmentation. All of the trades happen in one place. There's one thread basically in one place in the world, which is processing this instrument, right? That's the central limit order book.
Yeah.
The other model is more of what's called different things in different product lines. In FX, they're called ECNs, electronic communications networks. In US, in equities, they're called MTFs, multilateral trading facilities, or ATSs, alternative trading systems. Basically, it's more of a bespoke model where, you as a big institution or someone may want to go trade an instrument in a lot of size. But if you trade on the central limit order book, what happens is all of your trades get distributed to everyone in the world. And then that could create a lot of market impact for you. You could come in and you could do like a ton of volume. And then the price basically, say you buy, say you're a corporate and you want to buy like $1 billion euro in order to hedge some FX risk that you have. That will move the market a lot. And everyone in the world will see that this market is moving. So what you might want to do is you might just want to go to your favorite bank and say, hey, I'll give you the full size of the trade. I'll give you $1 billion euro. Give me a price which is better than the public markets, please. And you can hedge it however you want. And the bank may give you a better price because they may know how to hedge it better than you. They may already be short euro dollar, so they may be able to give you a better price because they want to exit some risk anyway.
Yeah.
And the electronified version of that is, these things, ATSs, MTFs, dark pools, different market structures which are not fully open, not fully transparent, not fully centralized. They have slightly different matching models maybe, but it's basically custom order books for custom people. Now, if you go to the crypto world, there's a lot of other stuff that happens because crypto, a lot of crypto exchanges are not necessarily trying to optimize for the most liquidity. So I'd say, in the institutional world, traditional assets world, and what we're trying to do basically ourselves is we're trying to get the most liquid market with the lowest transaction costs. Yeah. And that to me is the job of a marketplace, right? Like we want to create the lowest transaction costs, most frictionless, seamless trading experience for our users. Some of them may be retail and some of them may be institutional.
Yeah.
A lot of crypto exchanges, they don't really have institutional taker flow, right? So they have market makers who do market making, their companies, but most of the taking volume is done by retail, right?
Yeah.
And it's done by speculators. Retail don't necessarily care the most about liquidity. They're often not sophisticated enough to understand what is liquidity or what isn't liquidity. And basically what happens in these scenarios is, people trade on an exchange because they like the UX, not because it has the lowest transaction costs. Yeah. And therefore, these exchanges can do a bunch of things which improve their monetization but damage liquidity, like B-booking, which is the practice of where, if you send an order to the exchange internal market maker will say, hey, do I want to take this order or not? And if they don't want to take the order, it will go into the central limit order book, the CLOB. Otherwise, they will take the order themselves and trade it themselves, basically. And that basically reduces transparency and it reduces the trust of other market makers. The other market makers now, they don't see all the good taker flow. They don't see the orders they can make money on, so they've reduced the amount of size they show on the order book. Similar thing happens with delays. We're in conversation with a few kind of taker institutions who want to trade on our platform, and they've said, hey, we don't like trading on some of these other venues because we feel they add too many delays. If we send in a taker order and the taker order it's like a good taker order, right? Like we send in a buy order and then the market moved up a few seconds later, the exchange liquidity will actually move away because there's such a delay before the order gets executed, and we won't get filled on this order, which we would have made money on. So that's why we aim to have a very low latency, basically highest performance matching engine possible. Like I said, I think we are focusing just on traditional assets, and the game in traditional assets is liquidity, high volume flow, high institutional flow. Yes, we try and have a good UI UX as well, and we try and give the best seamless, most frictionless experience possible to our customers. But we're really targeting different things to what a lot of these kind of tier 2, tier 3 crypto exchanges target.
Yeah, actually, the B-book thing, I was in Dubai in November last year, and we went to a conference, and then I had to meet few people. So I met bunch of people running these crypto books, and all were turned out to be B-books. Like they're running their own B-book, and people aren't even aware that they're running B-books. And a lot of people.
I think the important thing there, as you said, also is awareness, right? So there are platforms out there, we have a lot of respect for, Variation, Austrian, whatever. They're very open with, we have internal market maker. You're only trading against the internal market maker. So then everything is kind of a B-book. But it's as long as it's not, as long as it's disclosed and people know what they're doing and people know that, hey, this isn't an open market competition, which is basically making these prices. It's the internal market maker. I think that's fine. And I think in some cases it's a better model, right? But I think if you want to hit that CME, NYSE, NASDAQ level of liquidity, it'll never work at that point. And it really depends what you're targeting to, right? Like in some ways, B-book is a better UX for a simple consumer because they don't have to worry about the intricacies of a central limit order book anymore. It's very easy. They just click buy and sell and they trade. And that's what those, a lot of these other companies have optimized for. I think as long as they're clear and transparent, it's pretty much fine. I think that the issue is when the exchange says like, yeah, there's no B-booking, and then in reality they're taking half the flow themselves. That's pretty naughty.
See, I think from my point of view, if you're starting a new exchange, I think it's fine to have an internal trading team who will make market for you on your exchange. Given that it's completely firewalled. Like if you look at Kalshi, the prediction market side, they have their own Kalshi trading, which does the market making for them. So I think even any new exchange start, they definitely get DMMs in the place, and they sometimes have their own trading team to get at least initial liquidity. So till that people are transparent and there is a firewall between the trading team and the exchange, I think there shouldn't be an issue in that.
Yeah, I think Kalshi is CFTC regulated. Obviously, you mentioned that in particular, and I think they had a very difficult problem in the early days because they made a brand new product. So we're going to our market makers. We're saying, hey, can you list equity perps? And there's already a little bit of, oh man, I've not done this before. Imagine listing like a contract on Taylor Swift's next song or Super Bowl or something, right? Like it's going to be very difficult for external market maker to do it, especially in kind of the HFT space.
Yeah.
So I think they had to do it that way, and there was no other way for them to bootstrap liquidity. And they're regulated, so it's pretty obvious that they have full disclosure that there's firewalling, and I don't think they would risk the enforcement action from the CFTC if they were doing something a bit dodgy. So yeah, I mean, respect to them. I think if you're making a brand new asset class, sometimes it can make sense to have internal market maker. We were just talking about this obviously before the podcast started about attention markets, Noise, and Forum is a new YC company, which is coming out doing attention markets. I think they're gonna have to do the same, and they're very open about it, that they're recruiting for internal market makers because they're making a new asset class basically, and they have to do it that way.
Also, what is your view on using automated market maker? So if you Polymarket have initially used AMMs to do the market making for them. It's basically bots which you just pool the money, give allocation to these bots, and start doing market making. So as per you, and it's a different actually market structure as compared to CLOBs, right? If AMMs are not exactly like CLOBs. So as per you, what is the advantage of using a proper CLOB with designated market makers or using AMMs for market making on your structure?
Yeah, so I've written an article and a thread about this. Basically, there's no such thing as automated market makers.
Yeah.
Market making is like is a brutal job, right? I know I did it. Like market changes every day, and you have to change your models, you have to change your strategies. Basically, the concept of an internal market, automated market maker is, basically the market maker sits there and, if somebody decides to buy, then, the price changes automatically. If somebody decides to sell, the price changes automatically. It's not on a fixed curve. Now, what is causing the price of that thing to change? Or in particular, say you have, say you have, we're in the equity perp space, right? So say you have Tesla, and say, we at QFEX list an automated market maker on Tesla perps, right? So there's Tesla perps. What will happen is, like, we'll have this fixed pool of money that our users have put in for the automated market maker, right? And Tesla price will move in, the actual Tesla market, right? And then it won't be that, the automated market maker's price magically tracks that. What will happen is somebody will arb our automated market maker versus Tesla and make money. So in automated market makers, all you've really done is, instead of having a central limit order book where the market makers are privileged to be able to cancel their orders, move them when the price changes, what you've done is you put their money into this pool, which is sitting duck for somebody to arbitrage. The arbitrage keeps it in line with the internal the volatility, but the liquidity providers in this automated market maker pool are actually losing money anytime the other price changes to an arbitrageur who keeps it in line. So that's a much worse model, because ultimately you don't want any kind of market making pool where the market makers are necessarily exposed to adverse selection, because all that'll happen in the case of volatility is a market maker will just blow up, right? It will just lose money constantly, and then it will just blow up. So I think that there's no labor arb here. I think it should be obvious, like the quant industry, there's thousands of people working there, probably 10,000 people. There's no arbitrage of, like, hey, we can just automate away their entire job with this automated market maker, because that ultimately the market has a duty to signal price, and price is signaled by people buying and selling, and the price is going to move first on these central limit order book models, and then these automated market maker models will just be picked off, and the liquidity providers will lose money, right? So I think that's the issue. People have tried to fix this, but hey, you can have bands in which my liquidity will trade, otherwise it won't trade. But then the concept of a band is just the same as, a level on a central limit order book. It's like, I'll only provide liquidity if the price is within this band or this band. That's the same as placing a limit order in a central limit order book, and then you just recovered a central limit order book, basically.
So also, basically, what made you basically leave HFT as an industry and start the whole trade, like bringing this crypto, like the concept of Perpetual, the crypto, like, from crypto to equity space? Like, what was the reason behind it? Like, what made you like do this?
Yeah, sure. So there were like quite a few reasons. I would say, a very simple one is I felt a lot of HFT. HFT is still growing as an industry, but it's not like crazy growth, right? Like, we have AI now. AI startups are growing like crazy rates. Even us, we're not like technically an AI startup, but we've been able to make an exchange in under a year, which is like completely robust and reliable.
It's very big work you have done in a year, to be honest.
Yeah, but it's possible due to code gen, right? Like, so this would not have been possible for AI. I mean, for the bulk, I mean, for the first 6 months, we had 2 engineers. Like, this is counting me. I don't even consider myself an engineer. Then I moved into the business side, and we hired another engineer. And like recently, we've hired another engineer as well. So we have 3 backend engineers right now, including the CTO. And we built an exchange from scratch. It's very highly performant. I felt that now was basically the time to build new businesses. That was like one piece of the puzzle. And I felt the growth rate in HFT, you join, Jane Street or Optiva or Tower or Jump or whatever in 2012, 2014, like, you have a lot of upside. I think, those guys were definitely making a big decision to choose those kind of firms versus, like, let's say a Goldman Sachs, for example. And they've been rewarded for that face by, HFT firms are basically taking over the trading space, and they're taking business away from banks. And a lot of these bigger firms, Citadel Securities, Optiva, Jane Street in particular, they're doing a lot of kind of very cash incentive business that typically banks have been doing in the past. So that's very interesting. And I thought, I like working at HFT for the intellectual, the mathematical problem, but I don't want to work in a bank, because then you're just a small employee, and it takes ages to get promoted and start making the big money. So it was a calculated decision on kind of the upside. That was one piece. A lot of kind of things came into place. Atmosphere became very business friendly in the US with the latest administration. One of my very close friends who I always knew would be an ideal co-founder of mine. He left his job at Citadel, so I was able to kind of poach him and say, hey, I've got this idea, let's work on it. And the idea, I was just very bullish on it. I think I've said this in previous podcasts, but I think that the cool thing about fintech in particular is that one of our partners at YC is Tom Blomfield, incredible guy. He made Monzo, which has an e-bank in the UK with like 15% market share or something crazy like that. He basically said, when he was building his bank, it's 2015, and the UK government basically came out with changes in the APIs that traditional banks were required to publish that made app-based banks possible. And he was like, everyone pretty much knew in a few years, like app-based banks are going to take over traditional banks, or at least the traditional banks have to come out with an app and they wouldn't be very good at it. But you still had to execute the idea and like make it work. And I think in fintech, because it's kind of more of a regulated industry, you're dealing with people's money, you don't want to like blow up people's accounts. I think the really interesting thing is if you're kind of knowledgeable about the community, you kind of know beforehand, like, hey, I think this thing is going to happen, this thing is going to work. It's the same thing with like perpdexes, right? Like the white paper for perpdexes was there from Hyperliquid in 2017. It wasn't until Hyperliquid really came out and like really got people to use it that it really became a reality all the way up in 2021, 2022. And, I had the idea. I thought it was almost a slam dunk. I didn't see anyone else really building it. And I was like, we could actually be early or on time to build this. And it was just something I was excited to work on. And I managed to convince my co-founder. He was like, he obviously background at Citadel, but not directly on the trading side. Very luckily, when I pitched the idea to him, we were on holiday in Cambodia with a bunch of my trader friends. And they were all in we were taking a bus to Angkor Wat, right? Like the temples. And I pitched the idea to him, and all the other guys in the bus were like, oh yeah, it's an amazing idea. And then he was convinced. He was like, oh, these guys probably know what they're doing, so it's probably a good idea. So yeah, I would say, combination of all those things, I would say I approach the startup and entrepreneurship culture more like a trader than like a typical Silicon Valley founder. We have very concrete idea of what we're good at, what we're not good at, what our edges in business and what we can compete on. And we try and move in a direction that basically optimizes for that.
So, by the way, did you face any problem regarding regulation while setting up the whole thing?
I can't really talk about regulation too much because regulators don't like it when you talk about them.
I get it. So but we have been discussing perpetual futures so long. But there might be people who actually don't understand what is the difference perpetual future and traditional future. So just give me a you just tell us the difference between a perpetual future and a traditional future, and why actually they are a real innovation in terms of the whole improving the whole market structure.
Yeah, so concretely, what a futures contract is basically an obligation to deliver or get delivered some commodity or asset at a price that you fix now, basically, but at some point in the future. So these were basically made for farmers. I mean, there's like lots of iterations, but like the modern future, let's say, was made in the Chicago Mercantile Exchange, and it was basically made for farmers to sell their wheat, which would harvest, or their crop, which would harvest a few months into the future at a price they can lock in now, so that they could plan their business and basically compute their profit and loss flows and not be worried that some weird event would happen which would like destroy the value of the crop, and then they lose money on the harvest. And basically people were willing to take the other side of the bet, and that's financial engineering, right? It's basically all financial engineering basically boils down to, let's take some cash flow which has some bad risk characteristics for person A and move it to person B for whom it has acceptable risk characteristics. And then people have a good deal. That's basically what all finance boils down to, and that's what commodity futures basically came from. And now, as almost a mathematical accident and a side effect, what happens is if you have access to trade the underlying of the instrument and the future, you can compute with reasonable accuracy what the fair value of the future should be from the underlying, using a condition called rational pricing, or also known as no arbitrage. And the reason is basically, basically if the price of the future trades out of line with the price of the underlier, you can do a trade which would give you risk-free money, and that trade always converges the price of these two instruments together. Then people start to realize, like, hey, what we're actually doing is we're trading this piece of paper, the price of which most of the time, almost all the time, pretty much tracks the underlier. But because it's a piece of paper, we don't need the money up front to trade it. and therefore we're effectively trading with leverage, right? So I have, I want to buy like $1 million worth of wheat, but I can buy it by just buying a piece of paper, which agrees to exchange the wheat at some price in the future, and the price of this piece of paper should track the actual underlying price of the wheat even now, right? And it's that observation that basically created the leverage trading industry. And move forward today, what's happened is the design of these futures contracts in the traditional world hasn't changed from that very old-fashioned contract of the wheat deliveries. It's changed a little bit. Now you can get contracts where instead of delivering the wheat, you can just exchange the cash as if you had to deliver the wheat and the implied P&L basically from that trade. But otherwise, design hasn't really changed. You still have these fixed expiries, but now you have kind of futures on S&P 500 where, there isn't really a concept of a harvest. So like, why is there a fixed expiry? And crypto basically came in and they took a more recent paper in the 90s by a guy called Robert Schiller. And it was Arthur Hayes, actually, at BitMEX. He deserved the credit for this. He's the one who popularized it in crypto. And he said, hey, this is a better product because people don't have to constantly buy and sell to hold this position.
Yeah.
It's very clear what the cost of holding the position is. He engineered the first perpetual contract. It was in crypto. It's just a better user experience because it doesn't expire. It allows people to basically trade the underlier as if they had the money to cover the full notional, but without the full money. So it creates leverage. And that's basically the concept of the perp. I would say in the traditional assets world, people aren't, a lot of smart people basically work in the traditional assets industry. So obviously something similar to this exists. It's called a swap, particularly an equity swap. FX swaps is something slightly different, but like in equities, it's just called a swap or a total return swap. Yeah. And it's basically a very, very similar thing. So it's basically a long-term contract where you say to a bank, I want to go long this thing. And then every day you look at what was the change in the price of this thing you went long. If it's down, you pay the bank some money. Otherwise, the bank pays you some money. You settle up constantly. But the problem is no one has put these on a central limit order book exchange. So that's the innovation we're doing now.
Yeah.
The concept of a swap, it only exists in an over-the-counter. You have to have a relationship with a bank.
Yeah.
I don't know if you've seen The Big Short. There's this scene
where you need to have certain capital. I know.
It's capital, yeah. You need to have an agreement in place. You need to have lawyers, and you have a lot of counterparty risk against the bank. Basically, if the bank goes bankrupt, right? Like if 2007 happens, Best and Lehman Brothers and so on, then those swaps are no longer honored, right? Yeah. Which is a problem. If you have a central limit order book, that risk of who's my counterparty gets borne by the exchange and the clearing system. And you can be confident that, hey, even if the guy who I technically trade on the other side of the trade, you don't even know who that guy is because it's an anonymous central limit order book. You just have to worry, like, is the exchange solvent? And as long as the exchange is solvent, my money will be fine.
Do you think basically bringing product from OTC market and making it more exchange oriented improves the product quality? Because if you see a lot of binary options are CME listed, but binaries are also more what you say OTC derivative as well. So do you think same way if you bring more products like let's say knockout options, you make it more exchange oriented, or you bring like you said you bring swap concept like here and may build exchange out of it. So do you think making bringing these products from OTC market and making more exchange oriented improves the product overall?
Yeah, it's a nuanced question. I'm biased, so I'm going to say yes almost all the time. I think it is yes almost all the time. There are certain cases where it's not the case. So OTC, what OTC really means is, so you can have electronic OTC, by the way. Yeah. What OTC means is there's no central clearer.
Yeah, central clearer.
So what that means is, I go and decide I want to trade with you. I now have counterparty risk. If you go bankrupt or you run away to a country and I can't locate you, I have to kind of sue you for the money. Maybe you don't turn up to court. But it's like very messy,
right? We have CCPs to hold function the whole trade. Then we have netting system in the OTC now, so it's a bit improved after I think after the whole this 2008 crisis. The OTC also became more regulated, not just regular, but more supervision, and they come with a lot of netting and risk concepts.
Exactly. Yeah. Exactly. So, like the examples I was using, the FX market, for example, is completely OTC, but it's actually traded completely electronically on regulated institutions from the banks. So yeah, I mean, FX is OTC because, there's basically no central clearer, right, that will do this. It has to be the central bank if it was anyone. They're not going to get involved in day-to-day dirty business of FX trading. If you look at other side, futures is typically where you see central counterparty models, because the future is kind of invented by the exchange. It's not a natural
Yeah.
commodity or product that exists out there in the world. And therefore, somebody needs to basically enforce the specifications of the future, where the money goes and so on. And that's more of a CCP model. So not all asset classes can move from OTC to central counterparty model and vice versa. What you asked about is, should we move things on exchanges as well? I think that was the hidden depth of your question, is not just like, when people think OTC, they think, there's some chat room in Bloomberg where there's these two guys who kind of meet for beers every day. They trade, guys or girls, obviously. That's not really necessarily true anymore. OTC trades can happen electronically. I think electronifying markets is always a good thing. I think moving markets away from kind of a chat room model is an anachronism, and it needs to move onto a more electronic trade venue. Now, I mentioned before, there are central limit order books, so CLOBs. Those are, very displayed, transparent, single order books for a particular instrument. And then there are other systems where, say some institution, they want to come in, they want to trade like $1 billion of Eurodollar, or they want to trade like $100 million of Tesla or something in one go. You probably don't want to trade on a central limit order book, because they would have a lot of price impact and they would move the market a lot. And you have to be very careful doing execution. And what they might want to do is they might want to trade directly with a bank who can give them a better price than they would get on the exchange, and they can execute it a little bit more smartly. Now, I think that should happen in an electronic way. That shouldn't happen in like an OTC chat. But people argue, well, some hedge funds are not sophisticated enough to trade electronically. I think the answer is you just force them by stopping all these chat trading, right? Market is moving in that way, obviously. And then there's hidden concerns with what happens if you have all these like alternative trading systems that is not a central limit order book. Liquidity is fragmented. A positive externality that markets provide to the world is giving like a very fair and transparent price. You now no longer have that. Robinhood, it's hard for the user to verify whether they're actually getting good pricing or not, and hard for regulators to do so as well.
Yeah.
Classic example is, Robinhood in the US, wire almost all their flow to Citadel Securities. That's kind of the designated market maker on that. Now, Citadel Securities claim, hey, we have some amazing alpha, and we don't want to trade that on a central limit order book because the alpha will leak into the market and we won't be able to monetize it very well. But we can give it to Robinhood because Robinhood, we trust, won't leak this alpha into the market.
Yeah.
But it's very hard. And because of this new alpha, we actually give the Robinhood users better pricing if they went directly to the market. The problem is very hard to verify this, right? Like, you have to look at microstructure level data, which is not public. So it could be, and I think probably Robinhood users might be getting better pricing because Robinhood users have this deal with Citadel Securities, but it's hard to verify. So as you can tell, very, very, very nuanced argument. I think OTC can be good or bad. Electronification, always good. Will it happen? Yeah, electronification, always good. Exchangification, always good. OTC, nuanced, very nuanced. I think a lot of people have, if you ask Alex Gurko, he's very pro transparency, but he's not necessarily very pro central limit order book, for example, if you read his papers. If you ask Ken Griffin, he's not going to say he's anti-transparency, but like, he's making a lot of money from lack of transparency. So, he'll probably say, hey, I have this great alpha and, I'm giving a public improvement to the market, but I'm not going to show this alpha to the market. So, a lot of people have different horses at stake, and it's very hard to separate, what's making them money versus what's their actual opinion on the right structure of the market. And even I don't think there's a right answer. I think a lot of very smart people, Alex Gurko is very, very, if you read his stuff, he's a very moral guy. He's not going to put anything out there that damages his personal intelligence and reputation. He's a super smart guy. One funny quote about Alex Gurko, he basically he's very anti-tax avoidance, income tax avoidance.
Yeah.
So one thing he does is every year, he makes like $1 billion in salary or something, and he just pays full income tax on it. UK government income tax, no optimization, no trust fund structure, no offshore, just to make a point that, he believes in something and he will do it that way. And even he has doubts, or he doesn't have doubts, but he has nuances on, is central limit order book better, is non-central limit order book better, all these kinds of things. So it's a complex question for sure.
Also, when we're discussing the whole OTC thing and you talk about liquidity fragmentation. So one thought I had in my mind, let's say right now we have futures, right? So every future have different expiry, right?
Yeah.
Let's say, do you think once we make it perpetual, you get a better liquidity in the instrument because you don't have the fragmented liquidity across the expiries? Because I think, let's say if I don't have multiple expiries, I just have one contract, one order book, and if everybody's trading that, we get a better liquidity at the end of the day instead of liquidity getting fragmented across expiries over 12 months or let's say over more months.
Broadly, yes, with some caveats. I think there's some products where almost all the liquidity is just in one instrument anyway.
Yeah.
On the future side, I think the real kicker is going to be on the option side. I think in US equities, let's say most people who want to trade with leverage have to do so with options.
Yeah.
Now, the problem with options is there are a lot of strikes as well as expiries. There are strikes.
Yeah.
And that really fragments liquidity because now all these options market makers have to quote 20 strikes and 20 expiries.
Yeah.
So, to give you an idea of S&P complex, so, that's SPX, ES, SPY,
Yeah.
all the strikes are liquid, all the expiries are liquid. That's around 2,000 central limit order books.
Yeah.
And it would be much better if, people just decide, hey, I want to trade SPX or SPY or S&P using a perp. That's one order book, right? So all liquidity is concentrated.
Yeah.
On the future side, there are some, particularly some commodities do have liquidity fragmented across multiple expiries.
Yeah.
Not all instruments. S&P is mostly usually one expiry, so I think on the future side it wouldn't make that much of a difference there. And it's I'd like to point out, like before people could catch me out on this, the advantages are really just for people who are trading with leverage, which is the vast majority of traders in these markets. Yeah. But there are still use cases. If you are, if you're a farmer and you want to sell your crop in mid-July, like you still want to trade a July future for sure.
Yeah, July futures, yeah.
But like those are like a small minority of traders now. Like most volume that flows through financial markets is institutional, HFT, speculative.
I was talking from that point of view, not from a farmer's point of view.
So, yeah, exactly. I just like to point out there, if you're a farmer watching this,
people, can pick out things.
perps are not for you. Yeah, perps are not for you if you're a farmer, for sure.
Yeah. So another thing. So Perpetual did not. So I think we have discussed it. So we will just leave it out. Do you think Perpetual eventually will replace the dated futures? In the especially on the not on the commodity side, I would say, but more on the equity side.
Yeah, absolutely, man. And like you just need to look at crypto where we already have perpetual futures, right? Yeah. How much of the volume is in perps? How much is it in random calendar futures, right? There's almost none. We didn't even bother trading it back at Tower, by the way, like the candy expiring futures. We were like, there's just no volume. It's not even worth the 5 minutes of effort it would take for me to run the strategy and have to look at it every day. So I think there's very strong evidence for product market fit, institutional, retail, corporate on the perp side. We see the evidence kind of hidden in the OTC swaps trading that happens with banks in the traditional asset side. When it comes on exchange, yeah, I'm pro electronification. I think the traditional futures are going to be left for the farmers for sure.
Let commodities guy have fun.
Yeah. I mean, like it's good. I come from a family of farmers. My ancestors, right, were farmers. Yeah, so
even my ancestors were farmers.
There we go.
Have a farmhouse, so we still do farming at some level. Yeah.
So, we don't have any farmhouses anymore. We've moved to the city. Generations ago.
So let's talk on the funding rate side, right? So funding rates are basically a bit technical for a lot of like new people or even people who are not much understand. They don't have much on the financial instrument, but as a quant, how important are they in terms of deciding like behavior and shaping the trading position and the market, basically building a trade?
Yeah, man, I'm actually gonna come out with a nice tweet that summarizes a lot of this on Monday. Funding rate design, I still think, has yet to find its full final form.
Yeah.
So let's take a step back. Like, what's the point of a funding rate? Basically, what happens is you want your perp price to track the underlier, because otherwise it's not like nobody has confidence that people want confidence that if Tesla goes up, the perp on Tesla has to go up as well, and by the same amount, by the way. So the problem is the perp on Tesla is not the same as the perp on is not the same as Tesla. What's the difference? Well, difference number one is you don't need the full cash to buy the perp on Tesla. And difference number two is if you have the perp on Tesla, you're not going to get the dividend. Whereas if you own Tesla, you get the dividend, right? Those are the two big differences. There are analogs in commodities. The analog in commodities is, the cash on one side to buy the gold, and the other side is the cost to hold the gold. And basically, like, if you bought gold physically, you would have to basically pay a safe or some warehouse to store the gold, depending on the quantity it was. And in like an efficient market where there's no free cash on the table, the market should be structured in a way that compensates people for the fact that you're owning Tesla perp and not Tesla, and if you want to hedge in particular, but you buy Tesla perp, sell Tesla, the cash flows, the dividend you have to then give up for Tesla has to be compensated by some cash that you get from owning the Tesla perp for a long period of time. So the way the crypto world does is perps. Futures have their own kind of weird self-correcting mechanism that they used to do this, but the way the crypto world, perps, they have funding rate. The way you want to design a funding rate is you want the funding rate to basically be stable and reflect the underlying fair value characteristics of the trade-offs between holding the perp and the underlier. And you basically have like a few levers you can pull to make this happen. So there's this kind of clamp that funding rate is zero or is equal to some like fixed interest rate around a clamp. You have a dampening factor, and you have a frequency that the funding rate is paid out at. For TradFi, the interesting thing is a lot of people have copied the funding rate formula in crypto for TradFi, which doesn't actually make any sense because in crypto, especially on altcoins, funding rates can be really high because the cost of kind of in crypto you don't have dividends, you have airdrops, right?
Yeah.
And airdrops basically give you some distribution, just like a dividend does. And airdrops can be very high, much higher than dividends typically are in stocks. So a lot of US tech stocks, there isn't even a dividend, right?
Yeah.
A lot of these US tech stocks, like growth scale companies, they don't pay dividend. Yeah. They don't pay dividend, exactly. So, typically you would expect funding rates to be really a lot lower in crypto. And you can see from a lot of the perp dexes out there, still working on, and a lot of them are kind of, without mentioning any names, a lot of them are actually changing their design, and they've kind of acknowledged there's a problem. I think while funding rates are really high or really low or really off for like a very long time, then there's always going to be this problem. And we have a surprise announcement coming on Monday, I guess that's the 9th of February, where we're going to detail exactly how we picked our funding formula, all the design choices we made, and how they link to the reality in TradFi perps, basically.
God. So I just want to go back to when you were discussing about UX in terms of you talk about UX and solving the UX problem as well. So actually, I remember you were talking about CME UX as well, right? Like you are like I think you've talked multiple times about the CME UX. Like they have a lot of expiries. Then you have liquidity rows. Then you have expiry codes, which is basically a bit difficult or like difficult for normal Joe to remember, right?
Mm-hmm.
So what was the moment where you finally clicked like for you and then you thought, okay, the entire system is broken, and you want to fix it with perps?
Yeah, I mean, like, not even normal Joe, man. Like, I was in HFT for 4 years, and even then, I only concretely remember, I think H is March, M is June, U is September, Z is December. I think F is January, G is February. Like, I have to figure these things out. Like, I'd have to take a bit of time to remember the codes. Doesn't really make sense. It was basically made for pit traders, so they could shout one letter at each other, and then it'd be very obvious which contract they were trading. The thing that clicked for me is I can say this because all HFT firms have like a similar strat. But on my last firm and the firm before, we were making a lot of money around the roll, right? So basically, when a future expires, let's take a commodity future on CME, most of them are physically settled. Basically, the people who bought the future for speculative reasons, they don't actually want to get delivered the commodity. Lean hogs is like a very active commodity on CME. They don't want to get delivered this lorry full of pigs, right? Like dirty pigs that like they have to then like what do I do with these pigs?
Yeah.
So what they do is they sell the future and then they buy the next one. And because this flow is very predictable around expiry end, you can pretty much predict like, hey, these guys are gonna sell, these guys are gonna buy it. And market makers can step in, and basically a ton of people have to transact twice in the market needlessly when they actually just want to hold the position. When they transact, they pay a spread to HFTs. They give very predictable flow to HFT, which is easy for their models to pick up and
then you have a
basically get in front of.
Yeah,
Exactly. You have to pay a transaction fee to the exchange to do all this stuff. So yeah, it's very wasteful. Not to mention all the operational costs of like, roll is coming up, like this day is when I'm going to execute. You have to probably have to pay a trader to go and execute these trades for you. You have to pay his salary or her salary. So yeah, I think it's that was an obvious thing to me. Is I saw how much money we were making. I obviously can't say exactly how much. But we were doing pretty well on this trade, and I was like, this money only exists because the exchange hasn't fixed the problem, and we should not. HFTs should not make money, right? In general, because all they're doing is contributing to an efficient market, and if a market is efficient, the amount of money extracted from the market, from real end users, institutions, farmers, hedgers, speculators, and so on, should not end up in the pockets of HFTs, right? Yeah. So HFTs argue that, we're providing a service where we make the market efficient and we give low spreads. But if they're making the market very efficient, spreads should be zero and they should not make any money, right? That's like the bottom line of it.
Yeah.
So, I saw how much we're doing and I was like, this is pretty much pointless. Like, this money is not available in crypto because there's no expiries in crypto. All the volume's in perps. And that's really what started this. That's when I was like, there's a real problem here. Like, there's going to be a lot of institutions who are going to move and start trading this, and we're going to go down that route.
Yeah, it can be a very big for a lot of. Even I remember I got stuck in one of my futures trade because it went to settlement, and I didn't even remember that settlement is coming. So I mean, a
lot of the times. Yeah. A lot of the times your broker will just like close you out at some like terrible price. It's very common. I've seen that before if you're about to get settled. Yeah.
So next, basically, I want to talk about the 24/7 markets because, and it's like the NYSE is already talking about it, and you are pro 24/7 markets. So as per you, it's just not, it's necessary to have 24/7 markets and not basically like nice to have. So how do you respond to common argument things like weak liquidity? There's problem of like there will be problem liquidity on the weekends, right? So what is the argument for that, and why do you think deferred risk from market close is actually worse than gradual unwinding?
Yeah, I mean, like, I don't really buy the whole. Well, I mean, there's 2 points to weak liquidity argument, right? Like, the point number one is that, there's. I mean, like, it's very obvious that, like, when you have the genesis of a new market makers come in and they don't have anything to price off anymore, right? So I've talked about previously on my Twitch about quote and cover. So the easiest trading strategy you have is like, there is some big liquid market out there, say in TradFi world, Tesla shares trade on NASDAQ, and you take the price from this market, and this is what our market makers are doing currently on QFEX, is they just like take this price and they add a few basis points either side. If they get traded on QFEX, they go hedge in the other market. That's very easy to make a liquid market. You don't have to do any work or any modeling work, basically. Now, the issue really arises, this is like the big long-term problematic issue, is on the weekend, there's just no very good, solid, consistent price source for you to hedge in. So if somebody comes to try and trade on QFEX, or a market maker tries to market make for them on QFEX rather, what they'll do is they'll look out there and they'll see what other equity perf markets are open. There's some CFD markets that are open. They're a little bit hidden. There's Hyperliquid, obviously Unit is kind of the forerunner there. They've listed Unit, Felix have listed some equity perps. Ostium. I don't think Ostium's 24/7. But there's a few sources of liquidity there, and they're like, okay, this let's say there's $1 million on the order book in Trade XYZ. That's Unit. Now if I get filled on QFEX for $1 million, I can go hedge all that in Unit, but I don't want to quote more than $1 million because I can't hedge it then externally, right? Or even if I do $1 million, I would have to take a lot of levels in the order books, a lot of slippage. And that's basically how you start getting markets formed is, they look at some other market, they maybe start quoting on a different market, they add a bit of liquidity, volume increases, then there's incentive for market makers like, hey, let's go try and trade against each other. Market makers compete for flow with each other, they increase their sizes, and then liquidity increases on QFEX, then maybe a new equities market pops up, and quoters on there kind of look at QFEX, they think, well, how much liquidity is on there. So it's a very gradual step process. When Bitcoin launched in 2011, right, like there was no liquidity, and now look at Bitcoin, right? It's like basically as liquid as NASDAQ. So I think those are very important things to monitor. Is like we're just early, and we'll continue to be early for a while. And then the other argument is like, hey, there's not much there's not as much volume on the weekends. The same in crypto, is not as much volume. And the answer is I don't really think that's a problem, because if people don't want to trade, liquidity doesn't have to be that high. Right? Very simple. Like, even if you look at US equity markets, almost all of the liquidity is in the auctions, the opening and the closing auctions. The amount of volume traded and the amount of liquidity available during the day is relatively low, because most of the big institutional money concentrate trading their trade sizes around the opening and the closing auctions, right? Because that's when their no liquidity will be maximum. So is the answer to that like, hey, let's start the market and then just shut it off for like, and then just have a closing auction? No, because news might happen in the meantime, and it's important for people to be able to express price views, and those price views to get priced in instantly, and people to be able to hedge their risks as soon as possible. Because that's ultimately what we're providing. The job of an exchange is to provide an environment for people to speculate and hedge risks. And if people need to hedge risk because something's changed over the weekend, the market has to be there for them. They can't wait until Monday morning. Just like, if they need to do a trade at, let's say, 11 a.m. Eastern time in the US markets, they're not going to just wait for the closing auction. They'll probably try and do that trade earlier.
Yeah. So also another thing, when we talk about 24/7, because it has been in talk for a while now. So I think basically the thing is, currently all the exchanges have a lot of technical debt, right? Because they build the infra for those weekends and 5 days trading, and now when they will try to move from this to hold 24/7, there will be huge technical debt they need to solve for. So it's more technical point of view. I want to know from you how the technical difference is for building a 5 days exchange and versus building a 24/7 exchange, from a technical point of view, from a tech point of view.
Yeah, so very interesting. I think like basically the first thing is there any requirement for there to be a central register of the assets, in that are they fungible across exchanges? So the reason I say that is futures only exist on the exchange that they're listed on, right? So if you buy S&P future on CME, yeah, there are S&P futures elsewhere. I think there's one in Brazil, for example. It's not the same product. You can't like tell CME, hey, I'm going to take this future to the Brazilian exchange and sell it there. Right? It doesn't work.
Yeah, we can do with the
Doesn't
stocks.
work.
We can trade across exchanges.
Exactly. So stocks, for example, there's a requirement for there to be kind of a central body which tracks ownership of all the stocks, which is about kind of the centralized clearing system. For example, the US is like a centralized system.
Yeah.
Exactly.
Yeah.
So when there's a requirement for that, the problem is a lot harder. So Nasdaq announced they're going to do 24/7. I think that is going to be hard because you have to interface with this other layer. Let's just talk about the future side for now. So for us, we're a futures exchange. We don't have to bother with any of that. We're like CME or ICE. The main issue is the way actually that the clearing and the cash flow system works. The way a lot of traditional exchanges are set up. We do a brief history lesson on exchanges, right? Sure. Exchanges typically started as trading houses, pits, in fact, where people would just scream orders at each other, right? And then there started to be a bit of structure in that, traders started to belong to firms which would clear for them and basically vouch for the fact that even if this trader goes bankrupt, we'll pay off their losses. And if you look at modern exchange structure, it's basically informed in the US by the Commodities Exchange Act, which was written a very long time ago when this was still kind of, electronic exchanges hadn't really got up and started and got trading. And they still have this separation of, exchange, clearing, broker, money is held in different places. And the main issue with 24/7 for them is how do we make it capital efficient? Because if you go trade on CME via Robinhood actually holds your money. But if there's a P&L transfer that needs to be taken place, that happens through a clearinghouse, which needs to happen on traditional financial rails. Yeah. And, those cash transfers don't happen over the weekend. They take a long time. They might take T+1 days to settle and for the money to move over. So the way you do 24/7 continuous trading is, as well as, tech perspective of like, maybe CME's binary has like a memory leak in somewhere that, they need to restart every night. Otherwise, like, there might be a problem, as well as those kind of tech problems. The issue is basically how do you move cash around fluidly and settle people instantly in a 24/7 way, such that if you go do a trade on QFEX and you buy a Tesla perp and then you sell Tesla perp 5 seconds later, that cash is available. You made some money. That cash is immediately available in your account for you to cash out. That's kind of where the existing system is broken. The cash is just held in too many different places, and the plumbing is not really there to enable ease of movement, which is a main block of a 24/7. Because a lot of these movements also become slower over the weekends when banks are closed. And the solution is to take them to crypto rails, basically.
Yeah, that's that. So the T+1 and the whole thing. A lot of times, you like even the margin get blocked a lot. Even if I trade my sell my stocks and I want to use that margin, I cannot use it because the broker is like, no, you cannot. It's yet to be delivered to you, the whole cash. So that's the problem with the whole the current system.
Yeah.
Also,
Yeah.
do you think?
Yeah.
I just wanted to more a tech point of view from you on this again. Is that so? How do you think, as per you, the current exchanges are going to solve this whole technical debt problem? Because see, you've built the whole tech from scratch, so you don't have those problems. It's an edge for you over them. But for them to solve that, how do you think? Like, because see, if they will see the business in the perp market, they will also want to come into that market, right? So how do you think like how much time they might take to build the whole infra again or change the things and to compete with you
It's
in terms of equity prop?
I think I think it's very difficult for them. I think like if you look, we had FTX
Yeah,
in the US basically submitted a request for the CFTC to allow this kind of more crypto centralized model
yeah,
to be regulated and licensed in the US. I think what happened there was the existing incumbent exchanges like CME and ICE submitted letters to the CFTC saying, "Hey, actually, we don't like this model. We think it's unproven, untested," which is true.
yeah,
They said we think it's riskier. I think that's not proven. Actually, I think crypto market can show it's kind of fine. I think a lot of people kind of sign up and they say, we'll take the risk if it allows us to trade
yeah,
24/7 and it allows us to trade with higher leverage. I think it's a decision for them. I think what's more likely to happen is these incumbent exchanges are likely to lobby against
yeah,
regulated changes in the market structure into more of like a crypto model
yeah,
rather than try and change. So I think they know that if the regulators come on the side of the crypto companies, that's going to be difficult for them to move with. So I think, you know, the thing with a lot of these like bigger exchanges, like CME gets retail flow fine, but they don't go out and do retail customer acquisition, right? Binance is, if you want to trade on Binance, you go on Binance's front end, Binance hold your money, Binance
yeah,
have the risk and clearing model, and Binance also have the exchange in the background,
yeah,
right? So Binance do everything basically
everything. Yeah,
end to end. CME, they don't go out and try and acquire retail customers, right? They leave it to, the
oh god,
interactive brokers, the tasty trades, the Robinhoods of the world. Now CME don't really want to get into that business. They don't have the setup for it, not even from a tech perspective, but from just a pure business perspective. It's not typically what they do. They do have institutional sales. I mean,
yeah,
I've met a lot of the institutional sales guys while I was trading on CME as professionally in my last jobs. But I think we're likely to see, if when I don't think it's an if, I think it's a when. I think when U.S. regulators, or, not just U.S. regulators, but when kind of regulators around the world go around and kind of acknowledge the advantages that may, obviously a decision for them to make, but acknowledge that the advantages of the crypto style clearing model exceed any disadvantages that may happen that you lose from this intermediated clearing model that the existing US exchanges have. I think it's going to be very, very hard for them to compete. I think either they'll try and do an acquisition, compete on that side, or they'll kind of consolidate their business. From a pure tech perspective, they would have to rewrite everything basically, and
yeah,
they would also have to break a lot of their relationships with their existing customers,
yeah,
like the brokers and stuff who already feed them a lot of flow, which is a very lucrative business for them.
yeah. So another thing is that if they have to go on this business, there's a lot of lobbying would happen from in a way, because there are a lot of people that are connected to the system, like custodian, clearing members, their brokers, and a lot of players around the whole ecosystem. If you try to
Yeah,
change the whole thing, a lot of people are going to get at risk, and I think there will be a lot of lobbying happen from the political point of view if we see, as compared to, so it might take them time to come into this. I think it's good for you people anyway. So yeah,
yeah. I think like I said, the story started around 5 years ago, 4 or 5 years
yeah,
ago, when FTX brought this to CFTC, and it's all a matter of public record. Like you can see the letters submitted by the existing exchanges, by the crypto community, FTX's own arguments. I think it just kind of ran out of time before FTX went bankrupt, when they would allow it basically. And we have some very smart people in the industry working on this problem, and I'm sure we have a lot of smart people on our side. Even though some of them might be our competitors, I think a lot of them are trying to achieve the same outcomes that we're trying to achieve. And there's like a lot of mutual respect between them. Look at Shane from Polymarket, Shane Copland has
yeah,
been quoted saying that he really appreciates all the hard work Kalshi have put into
yeah.
bringing
Getting the
regulated
regulatory
prediction markets
approval,
to the
fighting
US.
the case. Yeah, yeah,
Exactly, because it's actually good for the business as a whole, and it's good for the
yeah.
industry as a whole.
Yeah, let's talk about if you look from bigger picture point of view. So you have said centralized clearing socializes risk far better than the bilateral swaps. So
Yeah,
in post 2008 world, is
yeah.
QFEX essentially democratizing the swap market for retail traders while simultaneously fixing systematic flaws that institutions quietly hate?
Sorry, can you repeat that? I had to just tell my.
So basically, you've said that centralized clearing socialize the risk, like it distributes risk across the system. That bilateral swaps, right? I think we already discussed the podcast before also in the same one. So post 2008 world. So are you guys trying to democratize the swap market for retail traders while simultaneously solving a different part of the problems? Like the whole ecosystem have a lot of
Absolutely.
small flaws.
Yeah, absolutely. So, there's no reason. Well, I mean, there are good reasons that retail don't have access to the OTC swaps market. Is because they have to then enter into this very complex bilateral
Yeah,
agreement. It's standardized. It's called an ISDA, but it's still, you need to get lawyers and you need to go and really kick the ties on the business. There's no reason retail shouldn't be able to have access to those kinds of flows directly, those kinds of instruments. The only way we can do that really is moving away from the OTC model and more towards a centrally clear counterparty model. I think a lot of people don't realize a lot of these S&P ETFs and Nasdaq ETFs they're buying are swap replicated under the hood. If you own an ETF, please look up what the replication strategy is. Swap replicated means all that's happened is the ETF issuer has gone to a bank, taken out a swap that tracks the price of this thing, and then wrapped that into an ETF and sold you the ETF. Now, that's just an additional cost. The ETF issuer is charging 5, 10, 15, sometimes 20, 50 bips for this service. There's no service. The only service they have is that they've got an ISDA agreement out with this bank. We can bypass that whole system and save you those bips on an annualized basis, and that compounds over time.
So if you look at market as a game, right? So because people have a lot of approach from a game theory and poker and chess point of view. So perp seems to push market into something bigger than that. So philosophically, what shift are you actually betting on here? The market is going as a continuous game rather than an office or casino in a trade.
Yeah, I mean, I think that the whole point of TradFi perps is I think a lot of crypto markets are kind of a game, and a lot of people only really in crypto for short term realized gains pretty much.
Yeah.
What we're betting on really, if you dig down into it, is that we have this thing called crypto. Great thing about crypto is it was unregulated for a long time. Crypto therefore attracted very smart people who worked with very high agency, who wanted to move very quickly. They made all these amazing new products. Which like perps and there's kind of new clearing models and stable coins, which really powers finance. They made a lot of bad products as well, by the way. Not everything was perfect, but the important thing is they were able to experiment a lot and make a lot of amazing new things. And the bet we're really making is this is going to be accepted by the mainstream financial community where all the real volume is, and we move away from that casino model, that game model, and more into kind of helping people realize their financial outcomes, whether that's hedging, speculating, investing, short-term trading, news trading, any of those things. And that's I think a shift that we're seeing in the crypto industry. We're seeing a shift toward new market structures, openness towards new market structures in the financial industry. I think especially on the latter, a large part of that has been due to regulatory changes in the US and work done by the administration to recognize the efficiencies created by crypto markets. And that's something that's very exciting. We were talking to our council in the US, regulatory council, and they said, they haven't seen this pace of change from US regulatory agencies, US regulators like the SEC and the CFTC in 100 years. And I think that actually might be right. We're seeing a crazy amount of shift towards new innovation, and we should embrace that as much as possible.
Yeah. So also based on everything you have seen, what separate a trade I just want to talk from a more trading point of view a bit now. So based on everything you've seen over the years at the HFT trading career, what separates a trader who survived multiple market regime from a trader who only performs in a specific market?
Yeah, I think the best traders are very systematic, and that might be counterintuitive to people because a lot of trading is not systematic. So when people talk about systematic trading, they typically mean fully algorithmic trading.
Yeah.
But even if you are doing discretionary trading, you have to be very systematic in the way you make decisions, and very even the best kind of fundamental hedge fund guys and girls that I know, very, very, very sharp, very careful. All their decision making is logged, so data driven, and they go back and learn from their mistakes and see what things they could have changed, they could have done better. It's not like they've done the trade and then they forget about it, and then a month later they see what was it, they wanted the money. So I think people underestimate the amount of effort that's realized to be a profitable trader. Like you really, I would say if you don't want to think about trading, like just buy S&P futures and well, I mean they're not doing so well right now. Just buy S&P perps or S&P ETFs if you don't know much about futures, and that's the best decision for you. If you want to be a successful trader, you have to invest a lot in the infrastructure of making your strategy and your decisions and your approaches very systematic, even if you're doing it in non-systematic ways, and you have to be very data driven. Even if you are trading the news, you have to track, okay, what was the reason I did this trade? What was the reason I entered this trade?
Yeah.
What are my theses that I'm trying to validate? What's my null hypothesis, new hypothesis? What's my estimation of, the upside of this trade versus how confident I'm in my hypothesis? And the less data driven you are, the more kind of, these human biases like creep into it. And I think, that's why a lot of companies, people may have watched, what's that show where it's a US show where
Billions?
it's like a lawyer, yeah, billions, right? There's this like lady in Billions who's like the office psychologist who's super important.
Yeah.
Citadel are doing the same stuff. Like if you get a final round interview with Citadel, you have to do a 4-hour psychological test, because
I
this stuff
heard
is very important.
Citadel hiring performance coaches for their traders, like
Yeah.
sports coaches who were doing performance optimization for sports people. They are hiring it for their traders. Either like I read in the news way back.
Look, man, I was an athlete during university. I ran track, and I can tell you that's the spirit and attitude you need. Like being a trader, even if you're a quant trader or a systematic
Yeah.
trader or a discretionary trader, it is like a sport. You're out
That's
there,
like
and
yeah.
in tech, right? The pie can always grow, and now I'm working in tech a little bit more, and we have that kind of grow the pie mentality. If you're running an 800-meter race, that was my event, 800 meters. There's only one winner. And like the only way to win is to beat everyone else, and a lot of that kind of psychology goes into trading as well. And whereas
And
in tech,
also
there can be multiple winners, multiple
from a
products.
trading
Yeah,
point of view, it's also about a lot of mental fatigue that comes with decision making, especially when you're a discretionary trader or semi-systematic trader. A lot of
yeah,
fatigue has come from decision making when you
yeah.
trade. So if the stamina required for that is also something which I like people want to optimize for through performance like these coaches and everything, I think. So
Yeah,
yeah,
yeah.
yes, you're talking about this discretionary traders, right? So how should discretionary trader think differently when trading perpetual futures versus spot or dated futures?
I don't think they should think differently. I think like
Yeah,
obviously, you can lose money very quickly trading spot versus futures,
yeah,
depending on your leverage level. So that's maybe one thing. But I think in terms of kind of investment decisions, trading decisions, fundamental, like the exact architecture is the same. And in my last jobs, apart from some product specific things that we used to tweak a little bit here and there, our strategy for trading spot and futures, the core plumbing and the infrastructure of how we would collect the data, our methods for coding, debugging, iterating on strategies were exactly the same across different asset classes.
Also, what one metric or signal you pay attention to that you learn during your year like work and like years at HFT that most traders, retail traders, are not aware of or they ignore?
By signal you mean like a technical signal or something?
No, like yeah, from a technical
Okay.
signal point of view.
Yeah, I don't think I can say anything too specific because yeah, I don't want my previous employers to be angry with me because a lot of these signals, if I leak it out into the public sphere, like they will lose value because everyone will start doing it.
Yeah.
But there's a lot of very surprising stuff that works very, very well.
All right. If you have to give one generic thing which you can talk about in terms of at least understanding the quality of the signal.
Yeah, I think people. I mean, I was very shocked at how accurate a lot of these models can be,
Yeah.
especially on short time scales.
Yeah.
And I think that the interesting thing about markets is very similar. I come from like a quantum physics background. I studied like maths, like applied maths actually, mostly in kind of theoretical physics area. And there's an analog to this, which is that, in physics, you have like, the string theory that affects like the tiniest scales that you can't even imagine or fathom about, not even like large hadron collider LHC kind of scales. Then you have quantum field theory, then you have like statistical field theory, then you have like quantum mechanics, and you have like Newtonian mechanics, which we learned about in high school, right?
Yeah.
And the approach to study each of these things is very different, but they all kind of lead into the next thing. If you have quantum mechanics, let's say, you use quantum mechanics to basically figure out that, yeah, if in an approximation, you have mechanics as postulated by Newton from these quantum mechanics laws. In trading, it's very similar. On a very short time horizon scale, all of the drivers of the market are actually related to the order book and the orders that get entered into the order books and the orders that get cancelled and the trades that happen in the order book. And that's why models can be really accurate at short time horizon scale. I'm talking 100 millisecond, 1 second, 5 second, because basically you can get all of the data. It's very standardized. You can feed it into a model and the model can work its magic very easily. The long time horizon scale models are actually very bad because the things that affect stock commodity prices, it's more news driven, macro driven, very hard to predict those things. And I'm not an expert in that kind of stuff, but I know it's like a whole different ball game. Yeah.
Also, right now we are just talking about signal, right? So if you see a lot of trading firms are like HFT firms are now moving to MFT lately. Everybody's building an MFT team, even everybody started getting MFT stuff.
Yeah.
Do you think the reason for that is that there is alpha decay in the HFT business? So that's why they are like getting into MFT and increasing the diversification of the business overall?
Yeah, I think HFT is still growing as an industry as a whole. So the reason for that is, the market does become more efficient generally, but actually the amount of volume flowing through the market keeps increasing. So that's why HFT revenues are still like going up actually. FFT is just like a whole new product line, right? It's much easier. HFTs have the infrastructure and the exchanges set up and the business relations to do MFT very easily.
Yeah.
They just don't have the talent to do it yet. So what they've been is like, we can continue to try and grow HFT revenue 10% a year, or hey, let's hire a bunch of these smart guys, give them very high retainers, show them all the cool infrastructure we built to do HFT, which is the same infrastructure they need to do MFT. It's even more advanced than they need to do MFT.
Yeah.
And we can probably grow this business from like, 0 to 100 million billion very, very quickly versus adding another 100 million onto a HFT P&L. That might actually be more difficult. So I think it's just a land grab. I think it makes total sense when you think about it from like a business and synergies perspective. And yeah, I think a lot of it is also due to the fact that a lot of MFT, previously couldn't be done systematically because, as I said, the model quality, it degrades as you do MFT, and models recently have become a lot better because of increase in the availability of compute. Even 5-6 years ago, the sophistication of models you could train easily with the amount of compute power that was available in the world was not that high. Now you can trade very, very, very advanced neural nets. XGX, for example, famously have this huge supercomputer cluster in Iceland, one of the biggest in the world. At some point, it used to be one of the largest non-corporate, non-university supercomputer cluster in the world. That's been like a real unlock on the tech side that's enabled this to happen in the last 6 years.
Even QRT has started setting up in the Iceland. They've set up their own data centers and everything now.
Yeah. Exactly.
So, what was the hardest lesson you learned by building this your firm in last 1 year?
There's a lot of lessons. I don't know. There's one hardest one. I think the hardest one is that you have to be very, very, very careful in hiring. I think we wasted a lot of time kind of pursuing people who at the last stage were like, actually, no, they wouldn't be suitable for the company, or, it's weird because I got a lot of advice from when I was fundraising on, hey, you're going to be tempted to hire these people, but like, don't do it unless you're 100% sure. And I think, we learned some lessons the hard way on that side. I think that's probably the place where we've lost the most time is not approaching hiring like we do everything else, which is like basically in a fully systematic way and in like a very kind of data-driven and technical way. And a lot of roles that we're hiring for, we don't even know how to do those roles ourselves. So it's very hard to evaluate whether someone will be good at that when you don't know how to do it yourself. You just ask ChatGPT some questions. I remember interviewing some designers. My co-founder is way better at...
I can relate to that.
Yeah, exactly. Like I remember interviewing some designers while my co-founder was like, he was away or something, and like having no idea what the hell I was doing. And he's like normally the guy who interviews these guys.
Yeah.
I was just like, I think they kind of knew I didn't know what I was doing. So yeah, I would say that's the biggest lesson. Other stuff, I think we've been very lucky. Our journey has been fairly smooth so far. I think we've managed to achieve a lot, and we've been very lucky in timing that, we have a product that's going to go out there. It's going to do pretty well, hopefully, and has some kind of inklings of a customer base starting to start out. When we started this company, we didn't have a very clear idea of who our users were going to be, basically, and that was a bit frightening, but we've been very lucky on that side.
God. Thank you so much for joining today. It was great discussion on different front and also from a technical point of view. So thank you so much for joining. I hope we can do another one in future.
Yeah, absolutely. Thanks for having me. Great questions. Great mix of questions as well. Normally people don't ask about the tech side of things a lot, but that's actually what we spend almost all day thinking about. So it's nice to have those comments out in the open as well.
Yeah, thanks. All right, thanks.
All right. Cheers, man. Bye-bye.
Bye-bye.